that.
All right, good morning, everyone. Welcome to Shin-tastic Saturday. Hope everybody's having a beautiful Saturday morning so far. Just want to make sure that you guys can actually see me and how we doing here? You don't hear me? Hang on. All right, welcome everybody to Shin-tastic Saturday. Want to welcome everybody this morning to our webinar. First of all, just want to wish that everyone on this webinar is doing well. You guys are all safe and sound. This morning, I wanted to get a little bit technical with you. I know that over the last couple weeks, I've been doing some recordings or webinars that are somewhat inspirational and motivational, and I haven't gone into a lot of technical stuff. So this morning, I wanted to get into some technical things. So let me just bring up my PowerPoint here. Give me a sec, guys. All right, there we go. Okay, so there you go. I just we'll go ahead and get started. I want to probably do a short webinar with you guys today and let you guys enjoy the weekend and this beautiful Saturday this weekend. I mean, it's amazing. You know, a week ago, our temperature weathers were like 20–30% cooler, and here we are now almost climbing into the 90s. A couple of people already texted me this morning and said they were at the lake. So I was a little bit surprised that they were at the lake, considering that I didn't even know any lakes were open right now to the public due to the quarantine, but I guess they're out on the lake this morning. So anyway, let's go ahead and get started. One of the things I wanted to start off with this morning is car insurance. And I want to kind of go over car insurance 101, because I think, you know, right now with the fact that you guys are all quarantined, you're all sitting at your home or wherever you're staying at, and you're not driving. So obviously some areas that you can actually save some money right now is car insurance. So let me just kind of go over your car insurance basics here. And again, I want to share this with you and give you my thoughts and my opinions. And then at the end of the day, I want you to go and, talk to your auto insurance carrier or agent and have this discussion with them. But as you have this discussion, obviously understand that car insurance agents, auto insurance agents, are there to sell you a premium, and their commissions are based on, and they'll go, again, they get residual income, right? So whatever your premium is, they're going to get a monthly residual. I think it's roughly somewhere between 7 and 12%. Let's just say it's 10%. So, you know, the higher your premium, the more residual income they're going to make, right? And so one of the things that they're going to want to do is, when you're on the phone with them, is they want to have you keep your insurance premium high, right? Because otherwise, if they bring it too low, their residuals go down. So they may not always agree with what you're trying to do, maybe for their own interest, who knows, even though they're supposed to be working in the best interest of your personal demand or desire or necessity for the kind of coverage you're going to have. So let's talk about this here for a second and give you my opinion. And again, you can put your own opinion to it and call up your insurance agent and have a discussion. But, you know, when you look at 100, 350, so, you know, what does that mean when you're looking at your auto insurance policy? So what that basically means is this. This first number that you see on your insurance coverage stands for bodily injury. So what that basically means is this. Let's say you're involved in an accident, okay? And, you know, somebody, and this is what is required by law. Now, most states require 1530. I'm using a much higher number, and usually the numbers are like 1530, 3060, 5100, 100, 300, which is the example I'm giving you here. Then it goes 250, 500. Let's see, I've even seen like 300 and 300. There's I think it's about the most I've ever seen, you know, maybe 250, 500. But usually those are so what does that really mean? What that means is that and this is what's required by law, is that this $100,000 is the insurance amount that is required in case you actually hit somebody. Your negligence or reckless driving or accident or whatever, you know, the other people can claim to your insurance company $100,000, right? Now, if you had, let's say, 3 people in the car, this 300 basically means the 300 stands for the total bodily injury that everyone has in the car. So if you had 3 people, then each person would get $100,000. Now, if there was 4 people or 5 or 6, they would end up dividing that $300,000. So it's 100, 300. So it's really important to know, you know, a lot of people have 15, 30, and honestly, you know, that's not enough. I mean, that is the bare bone minimum required by the state. But honestly, I would tell you the difference between 15, 30 and 100, 300 is not a lot. And so I would tell you to find out what that difference is and increase your policy to 100 and 300. Now, for those of you that are leasers on your car, the leasers require a minimum of 100, 300. Some even require 250, 500. So you just have to check with your bank or your leasing financial company that provides you the lease on your car and find out what the minimum is. But typically the minimum is 100, 300 when you're leasing a car. Now, if you're a homeowner, right, and you own a house, I would tell you to even go higher than this, maybe go to 250, 500. But if you don't have anything, and even 15, 30, I think is a little low because you could be responsible for future income out of your own money. So you may even want to bump this to 50 to 100. But again, like I'm telling you, it's like sometimes just a few dollars for the difference. So you may want to talk with your insurance company or your insurance agent and find out what that difference is. Now, here's a number that scares me because a lot of people hear it's like 10,000, 25,000, even 50,000. This is damage to the vehicle. So this is property damage. So what that basically means, if you're involved in an accident and you hit the other people's car, you know, and their car has sustained some damages to their vehicle, that 50,000 would cover the cost or replacement or the repairing of their vehicle. So this number in the old days, you know, and I've said this before, that, you know, maybe 25,000 was, you know, somewhat reasonable because most people had a fender bender. And if you bump somebody's car, you know, their fender, it was like 10 grand, right? Or even $5,000. Now, today with your auto insurance, with your car, your property damage, you know, a fender bender now can cost like $15,000, $20,000 because there's so much technology behind a bumper, right? Today, our bumpers now have motion sensors, they've got cameras, there's all these other technology on a bumper. So when you hit somebody's just bumper now, that could be $50,000. So let's just say that you had only $50,000 in this example. And let's say you hit a Ferrari, a Lamborghini, a McLaren, a Rolls Royce, a Porsche, some German, you know, car. This number, like if you hit a Rolls Royce and you hit a bumper on a Rolls Royce, that's probably going to cost you like 65 grand, right? Because it's just the pieces that are in a bumper that's attached to the Rolls Royce, it's the way it's designed, you're going to pay a whole lot. Now, if you only had 50,000 and the total damage was, let's say, 120,000, you know, the automobile owner and or their insurance company could come after you for the difference of $70,000. So I always tell people, if you're driving by a Rolls or a Bentley or, you know, some expensive exotic car, be careful you don't drive too close to it because you get in an accident with them. Yeah, it could cost you a lot and even some of your future income. So again, this number here, I would even encourage you to bump this up to maybe even 100,000. So go like 100, 300, 100, right? Or 250, 300, 250, right? Kind of depends, you know, like what kind of cars you're driving and, you know, the replacement of your vehicle, all that kind of, the other people's car. Man, if there's multiple cars, right, this could be pretty pretty costly. So again, I would, tell you to increase these limits here. And again, it's not a whole lot. So again, the 50,000 or the 50 right there stands for property damage liability that you caused to someone else's vehicle if you were at fault. Okay. I'm starting to see some hands going up here, and we'll answer those accordingly. Hopefully my staff is paying attention. So now here's an area, this is your comp and collision deductible. So again, when you're talking to your insurance agent, you've got your 100, 300, those are your limits, and then you've got your comp and collision deductible. I see most people pick like 100, 250, 500. I would tell you to go minimum 500, but even on my vehicles, on most of my cars, I've increased my deductibles up to like even $2,000 deductible, because I mean, I really don't want to have my insurance getting involved for my cars, because I personally have some exotic cars, and I do have a Rolls and all those kind of things. And I don't want them getting involved for like a minimum. I want to be able to participate and pay $2,000. Now, it's because one thing is I can also afford paying $2,000. But by increasing your deductible, it also decreases your premiums. So you may even want to consult with your agent and say, hey, what would it save me if I went from my $500 to $2,000, right? So if you're a pretty good driver, maybe you want to go to a higher deductible for your comp and collision to help you reduce that cost of insurance, right? Now, here's one that, personally, I don't have uninsured motorists or underinsured motorists. Underinsured and uninsured coverages do have some different types of coverage, but they provide coverage for bodily injury and property damage loss combined. So what does that mean? So what it pays for, uninsured motorist covers you for your medical bills, for injuries to you or passengers in your car. So for me, I mean, if I'm driving my Ferrari, it's only a two-seater, and in my two-seater, it'd be usually one of my kids or me and my wife, and that's about it. So when I look at my uninsured motorists, you don't really need uninsured motorists if you have your own personal health insurance policy. So I have a pretty solid health insurance policy, and my health insurance company would pay for all my medical bills. So when I look at uninsured motorists and underinsured motorists, this is coverage really for lawyers to know what they can go after, right? And so if you're looking at pain and suffering and lost wages and all that kind of stuff, maybe you want to look at uninsured motorists, but honestly, in my opinion, if you already have a health insurance coverage, this is redundant. It's like double coverage, right? Now, some of you may even have an umbrella policy, and if you own one, you know what it is. If you don't, you may want to consider getting one. But it's so important for you to understand the importance of an umbrella insurance, which I'm not going to get into today. But let me just tell you this. I know I've been talking to some people lately, and underinsured or uninsured motorists really has not been in the last 2 months a huge problem for most people, mainly because you're confined to your home, right? You've self-quarantined yourself to help flatten the curve, as everybody's been alluding to. And so why would you even need uninsured motorists, right? The chances of you getting involved in an accident is pretty slim right now, especially because you're not on the road. So you may want to call your insurance agent and say, hey, can I just get rid of this? I don't even think I need it, and personally, I don't even think I'll even need it even after the quarantine, but I like to remove this. So they'll prorate this uninsured motorist with you, but let me just tell you this. For me and my family and my kids and the number of cars that we've got and, my parents' coverage and everyone else in my family, we don't have uninsured motorists now. We actually removed it. I actually thought I did, I actually did it I was talking to someone last week, and the amount of savings they had on their insurance, it was substantial. And then as I was having a conversation with them, I thought, well, if I'm telling them to do this, right, to like remove this policy, remove this part of their insurance policy, I should take a look at my own policies. And when I looked at my own, I think it was like over $15,000 in savings for the entire year for all my cars. So that's pretty substantial. I mean, it's like over $1,250 a month in savings for uninsured or underinsured motorists. And again, I removed this mainly because I don't need it when I'll have my own insurance policy. not to mention I do have an umbrella policy as well. So for you guys, you know, you may want to consider removing this and talking to your insurance agent on Monday and seeing what your savings are, okay? So now, why am I telling you this? Because as your clients are saying, hey, they're saving money here, it could be $100, $200, $300, $400, $500 a month. Again, if they already got, not homeowners, but they got health insurance, this is redundant. The amount of money they were paying here could be money that they can actually be putting somewhere else, like buying a disability insurance policy, getting long-term care, getting life insurance policy. Maybe those of you that joined us today for the very first time, there are now life insurance policies that include all three. Okay, so there's life insurance policies. In the past, the way life insurance worked is that the only person who really benefited from that, you know, financially was the beneficiary. So the person who got the policy on their life really never benefited from life insurance unless, you know, they had some cash value build up and they, took that out. But now there are living benefits that are included in life insurance policies. So what I'm talking about is you get life insurance that you give to your beneficiaries, but then there is long-term care, there's chronic illness, there's accelerated death benefits, there's also, what am I looking for? Disability insurance. So disability and long-term care are your living benefits. And so, whoops, what just happened here? Sorry, guys, give me a second. My computer just started updating on me, so before this starts taking over my computer, let's see here. All right, here we go. Sorry about that, guys. All right, so I lost my train of thought. My computer started updating, and I apologize for that. Thought I had turned that off. I guess I didn't. So again, you can take this difference and get a living benefit on life insurance where it includes long-term care and disability for you. So if you were injured, got the coronavirus, et cetera, then that would actually cover you for all your lost wages and stuff like that, right? So again, very important for you to be very proactive right now as you're quarantined at home and make these calls to your insurance company, especially your auto insurance, since you're not driving right now. And I would tell you that for those of you that are, I'm not really sure, to be honest with you. The media is saying that by May 15th that they're going to lift this quarantine or, the stay-in-home ordinances, or they're going to do kind of a gradual type, stay-at-home changes or whatever. The bottom line is, again, if you do have health insurance, I'm not sure if you really need this because I think it's extremely redundant. Take that extra premium and go and buy yourself a life insurance policy that has the long-term care and disability, okay? So just something for you to consider, some food for thought. Go and pull your policy this weekend, right? And examine and analyze your policies with your agent. If you have any questions on this, please feel free to reach out to me. I mean, you could take a snapshot of your insurance policy and I'll look at it. We could do a quick text or a quick phone call and tell you what I think about your policy. I'd be happy to do that today and tomorrow. I mean, what else am I doing in my house? Nothing, right? I mean, I'm having webinars and Zoom calls and calls like this with each and every single one of you. And please reach out to me. I mean, that's what I'm here for, to help you guys understand your auto insurance policy. Okay, now let's talk about, now we're going to switch gears and talk about your 401k plans, right? People who have 401k plans, there are so many businesses. In fact, we have an associate of ours, her name is Catherine Simnowski, and I are now working on a 401k plan. And the good news about these 401k plans is, hopefully I get your attention here, is that, there are 401k plans that you can do these plans with just a life insurance license. Now, for those of you that are joining us maybe for the first time, have no idea what I'm referring to, this is another opportunity maybe for you to make another stream of income, right? Another passive or residual type income opportunity where you all know that there is a 401k plan in place for most businesses. Now, my intention was to create a slide for you today that says that there are some laws that are going into effect, that are in effect today, that will begin to take place like right now in the month of May, and by June, and even by next year. There are some rules in each state, and especially in California, where small business owners are going to be required to have some sort of a retirement plan for their employees. And a 401k plan is probably going to be the most popular plan that these companies are going to adopt. Now, so I want you to know that this is a tremendous business opportunity where you can actually go and start planning, putting together some 401k plans. So what exactly is a qualified plan? So a qualified plan is an employer, the key word is the employer, so the person who owns the business, an employer-sponsored retirement plan that qualifies for special tax treatment under 401A of the Internal Revenue Code. So most people have a 401K, okay, and that's just, you know, a corporation or some sort of a business that has, is titled under an entity, right? A corporation or an LLC. So now what happens is a qualified plan must be maintained exclusively for the benefit of the employees. You'll see here for the employees. And the plan must be in writing pursuant to a plan document. So there is a document adopted by the corporation or the employer and operated pursuant to the terms of the plan. This is basically the contract or the constitution of the 401k plans, and it must not discriminate in favor of highly compensated employees. So what happened was when these 401k plans were originally designed, they were really for the benefit of the highly compensated or the owner of the business, because obviously they had money and they can afford, because they were getting typically paid a lot more money than the rank and file and some of the entry-level positions, right? So, you know, all of a sudden these different groups started to come together and said that these plans were discriminating against the people who weren't making enough money, and it was really in favor of the highly compensated, because whatever you put into these 401k plans, they were tax deductible, which means it would reduce your taxable income. So if you were making, let's say, $100,000 and you put $10,000 into this, instead of getting taxed on $100,000, you would only get taxed on $90,000. So it was very, very favorable for people who were making a lot of money. So now you cannot discriminate, and it has to benefit every employee. And there are some minimum eligibility investing requirements. And so I wanted to go over some of these things in just a minute, but there are two different kinds of plans. They were called defined benefit plans, which is the traditional pension plan. So when I mean defined benefit, that means that nobody, the employees don't put the money in, and it was only the employer who was putting the money into this plan. So these are your traditional pension plans. And we'll talk about that, and we'll talk about defined contribution plans. People will refer to these plans, or employers, chief financial officers, human resource people will refer to these as DB, right? B as in boy, DB plans, or DC plans. So these DC plans, defined contribution plans, would include your 401k, profit sharing, money purchase plans, and stock bonus plans. So let's talk about each one of these a little bit more in detail. So defined benefit, the benefit formula with actuarial benefits to be paid determined at retirement. So these actuaries are called actuaries, would actually determine, you know, how much money somebody needed at retirement. And all the investment risk lied in the employer. So the employer had to make some good decisions as to know where to put that money, and also had some massive fiduciary responsibilities to put that money in the right place and keep it safe for the employees. And then the employer contributions had to put money in there to determine how much money that these people would get or the employees would get at retirement. So really, when it was called a defined benefit, employees never put money into this. It was only the employer who would put money into these plans, and the benefit went to the employee later on when they retired. Now, these are more what they look like. Defined contribution is where the participant's account balance at a given time, they would put money into this and be able to retire at, let's say, 59 and a half. And hopefully they made the right investment choices, they being the employee, the participant, and all this investment risk relied on them. So they had to figure out how to invest their money wisely to make sure that they were getting the right rate of return so they could retire at a certain time. So again, you'll see these numbers, and this is just some of the laws. In 1975, 74.1% of all active plan participants were actually DB plans. So these were the pensions that we refer to, and you can see by 2016, it says that only 26.46% of all active plan participants were in a DB plan, okay? So, and when we examined these people that were in a plan, a DB plan, you know, a pension plan, they discovered that almost 95% of these people were actually government employees. So if you were in the private sector, it was even lower as to how many of these people were actually getting into one of these plans. So you can see the decrease in pension plans. And what's now happened is now that responsibility has shifted, we're in 1975, you know, only 25.85% were participating in a DC plan, a defined contribution plan, i.e. a 401k, and today, by 2012, you know, this number has now gone to 74%, and you know, these numbers are even higher today. So you can see that the big shift in these 401k plans, and now with the new laws coming down here in California, these numbers, and not just California, it's all the other states as well, requiring mandatory 401k plans for their employees. So most plans, I don't want to go into that too much. So now, how much can you put into that? Well, into these plans, there are limits as to how much money you can put in. It's typically $19,500, the lesser of, or 100% of your compensation. So these are your 2020 limits. They've actually gone up to $19,500. And there are some catch-up provisions, okay, for people who put money into these plans that are over a certain age. So if you're over the age of 50, okay, you can actually put in not only the $19,500, but you can actually put in an additional $6,500 of catch-up provisions into these types of plans. So now the one thing that I wanted you guys to know is in the old days, these plans were tax deductible, and then they grow tax deferred, so you don't pay any taxes on the accumulation. But when you hit 59 and a half, anything you take out of that now becomes taxable at ordinary income. Well, what's happened is a lot of the older 401k plans now have not upgraded or adjusted or improved their plans, where many of the 401k plans now offer what they call a Roth 401k plan, a Roth 401k. So what does that mean? A Roth 401k plan says to the employee, you forfeit the tax deduction. The money still grows tax deferred, but here's the great part about it. When you actually turn 59 and a half years of age, anything you take out of those plans are now tax free. So you're not subject to any income tax. So it's a pretty amazing thing to not have to pay any taxes on any of your growth. So a lot of these 401k plans only have the traditional plan, which is you get the tax deduction, right? It grows tax deferred, and then on the back end, you pay taxes. Well, today, it's a tremendous opportunity during this quarantine period to reach out to the owners of businesses and or their CFOs or human resource people and see if they want to convert their 401k plan to a more robust plan where they can actually have both. You can have the traditional platform, but you can also offer the 401k, the Roth 401k, and actually have both. So for an employee, if they're saying, hey, I'm going to put in, $10,000 a year, they can actually put 5 in the traditional plan and get 5 into the Roth, and they can actually diversify their money in both accounts. So pretty nice opportunity for you to reach out to people. Now, one of the things that people always ask is, well, where do I find these businesses? Like, where can I go and find out, all these different companies, how much money they've got, how many employees are there, et cetera, et cetera. So I've got a homework assignment for all of you, and one thing I would encourage you to do is I want you to go to Free ERISA, www.freeerisa, E-R-I-S-A, so it's F-R-E-E-E-R-I-S-A, freeerisa.com. When you go to freeerisa.com, what happens is that every employer, right, the business owner has to file what we call a Form 5500, a 5500 form. When you fill out that 5500 form, it's public information, okay? That is an IRS document, and it is public information. When you go to freeerisa.com, you can actually go in and type in a specific zip code, and it'll tell you all the different businesses in that zip code, and you'll actually see how many employees there are and how much money each plan actually has, okay? So now when you go in there, not only will you see how many employees there are, you can even filter it as to looking at certain businesses that have certain assets. So you can look at, like, I only want to see businesses that have $10 million or more, right? Or $5 million or more, or $2 million or more, right? Or $1 million. And you can filter it out and punch it in, and it'll give you all those businesses. Now, here's the best part about freeerisa.com is that it also tells you every business that is delinquent in what their plan has. So it actually tells you that this particular plan has issues with diversification, hasn't filed their 5500, all that kind of stuff, right? It's pretty cool. Now, you do have to, if you want to get more information and get more detailed information, there is a small subscription fee, so you can actually buy into it. And for me, I would look at it as an investment. But once you go in there, you have all this information, and you can actually, and it even gives you the name of the contact person at the company. It gives you their phone numbers. It gives you everything. It even tells you who their prior company that they're working with is, right? Who their third-party administrator are. So these are all things that are on freeerisa.com, and I would tell you to do some homework this weekend. And if you want, we can even get some of you, like a group of you, get you guys on a small webinar, and I would encourage you to talk with your friends that are on this webinar, because a lot of you guys kind of know each other, and maybe we can get 10 of you on a webinar with me, and we can go to Free ERISA together, and we can go and check it out and browse it and see how to work that, what to look for. Again, today I don't have time to do that, or maybe we just set up another webinar and talk about how to go and explore freeerisa.com. Okay, I'd love to do that with you guys. Because what else are we going to do right now as we're self-quarantined, right? So tremendous opportunity to go and help businesses upgrade their current 401k plans. And again, all you need is a life license to do this, okay? And if you don't have a life license, then guess what? Get one, right? I mean, you can get one in like less than a week. And literally, we give you the questions and answers. You study it, understand some of the concepts, and go in and take the exam. In California, just so you all know, the the passing score is only 60%. So if you get like 80 or 90% on the exam, then you overstudied, right? Because no one's going to know that you either got 60% or 90%. Everyone gets the same license. So I would encourage you to plug in and get a license. Why not? I mean, it's a tremendous, it's just another license to have under your belt, right? And be able to go and, and understand money better than you currently are right now. Again, take this opportunity during this, opportunity meaning this quarantine period, and learn something new, right? I mean, go out there and explore and get another license and build another residual income opportunity. So again, these Roth contributions are after-tax contributions. If you hold them for 5 years, earnings will be distributed 100% income tax-free. You know, whenever I see the words income tax-free, it like really resonates with me, right? Because I like paying my share of taxes. I just don't want to pay over taxes, right? Normal plan distributions do apply, you know, early withdrawal penalties like the 10%, federal penalty tax. If you take money out prior to 59.5, and again, if you live in California, it's a 2.5% penalty on top of the 10%. So you're essentially paying 12.5% in penalties. Again, the Roths are very similar to the traditional 401k plan. There are matching programs where, you know, where an employer will, you know, match for every dollar that the employee puts in. There's an incentive here for the employees to put money into this. It is not mandatory, but it is an incentive for a lot of these people, for the employees to participate into these plans. Now, there are these things called vesting schedules, and again, employers, 2020 contribution limit, $56,500, and then here's the vesting. Typically, here's how vesting works. Typically, they'll say it's like you get 100% of all the money that the employer gave you, the matching, over a 3-year period, or they have what they call a graded plan. So you don't get all the money up front. I mean, you don't get like whatever the employer matches, you don't get it all. Like they'll say you get 20% at the end of the 2nd year, and then you get 40% on the 3rd, 60 in the 4th, 80%, and you got to stay there for 6 years to basically get all that. Now, this is basically an opportunity for the employer to keep the employees from quitting or moving to another company. And this has a lot to do with training their employees and keeping people there and having that tenure so they don't have to retrain, because training your employees and your staff, is very costly, right? It's a very expensive process. And so you bring somebody in and they, you know, you train them and then they leave, and then you got to find somebody else to do the same thing over again. And you're constantly training and you're not working very efficiently. Plus it's costing money to train people, right? So even myself, I mean, I got new people coming in, working for me on my staff, and it's like a process to hold their hand, you know, step by step by step, and, you know, doing it the way that we want them to do it. So very important to know that this is a vesting clause to keep your employees from leaving and going to another company. There are eligibility requirements. You know, you got to be at least 21 years of age, 1 year of service, at least 1,000 hours in a 12-month period, with at least semi-annual entry dates. Employer may provide a 2-year service requirement for contributions if the contribution is 100% vested at the end of the 2-year period. So, you know, there's all these rules that the employer can keep in place, and I see this 2-year service requirement as a mandatory, not a mandatory, like a thing that I see almost all employers put in place, okay? Hardship withdrawals, there's immediate and heavy financial needs, no other funding source available. The amount is necessary to satisfy the need. Let me kind of put it to you in better. Hardship withdrawals, here's what it is. Bottom line, certain medical expenses, purchase of a primary residence, tuition payments, foreclosure or eviction, burial or funeral expenses, repair of damage to principal residence. These are all reasons where you can have some hardship withdrawals, but again, you are still going to have to pay the tax, but the IRS may not assess the 10% penalty tax, and the state requiring the 2.5% penalty if you can show proof that your hardship withdrawal, your withdrawal was based for one of these reasons right here. Again, earlier I told you about the 10% early withdrawal penalty applies. Again, you are going to have to pay ordinary income tax, subject to somewhere between 15 and 35. That's something you should probably consult with your accountant or CPA and tax preparer to figure out exactly what your tax bracket is. But there you go. Most of these plans do have what they call a loan provision, and if you're putting these together for your employer, I would always tell you to convince the employer to have loan provisions available. Loans can be taken for just about any reason, but here's the big thing. Just so you know, these loans do have to get paid back within a 5-year period of time. So let me see if I got in my next payment. Here we go. My next slide. So at least quarterly payments have to be made. And again, if you don't pay this loan back out of these 401k plans within 5 years, the IRS does deem it as a full-blown distribution. And all of a sudden now, whatever that remaining balance is could be subject to the 10% penalty tax plus 2.5% if you live in California, okay? So again, very, very important for you to understand that a lot of these people that have loans on their 401k plans, that, you know, they're taking these money out, they could be subject to that 10%. Now, right now, under this quarantine provision, there's a small provision under the CARES Act that says that if you're taking that money out of these 401k plans for financial hardship, pay your bills, medicals, and stuff like that, they are currently right now waiving the 10% penalty tax. So this could be a great opportunity for people to take money out if they really, really need it. I mean, I would discourage people from taking money out of their 401k plan or any kind of retirement account. So I mean, I've got mixed emotions about this because I understand that if you're in dire need of getting access to that money to pay for your medical bills or, you know, paying your bills and covering your mortgage, I get it. And so know that, you know, the IRS is waiving the 10% this year all the way up to the end of December 31st, 2020, okay? So that's about it on the loans. Anybody who has, now somebody who has money in a 401k plan, termination of employment, age 59 and a half, disability or death, you could take a distribution on this, right? Now know that when you take a distribution for termination, right, of employment or disability, you could take this money and you can actually roll it over, right? So I have been very proactive, calling a lot of friends that I know that have a job, and I asked them, hey, how's it going? You know, how's it going at your work? Are you on furlough? Have you been laid off? I mean, what's your situation today? And they say, yeah, John, I just got notice that I've been officially laid off. So I'm I'm trying to get unemployment right now. I have no income. And I said, oh, well, do you have a 401k plan at your work? And they'll say, yeah, I do. And I go, well, what are your plans with that? And they say, I don't know. So this is where, and I'm telling you, almost 99% of the people I've spoken to, that was their response. I don't know what to do with that money. So several of these people that I've spoken to in the last couple of weeks have told me that they need to roll over that money now, and I'm now in the process of rolling over their money from their existing 401k plan to these new plans that we've got. And if you've been in some of my other prior webinars, you'll know that, you know, a lot of those monies I'm putting into these different types of fixed indexed annuities. And again, I don't have a whole lot of time to talk about those, but those are wonderful, wonderful vehicles, I think, for most people. And what I also discovered with a lot of the people that I've been talking to is they said, oh, John, by the way, they said, I also have an old 401k at this other company, and it's still there. Like, I never rolled it over or did anything with it. Should I move that money as well? And I was like, absolutely. And one girl that I spoke with actually had 5 different 401k plans that over the years she just switched, and she was actually a nurse. And so she's actually got money at one place to another place to another place to another place, and she just left the money there. And so I said, oh my God, I said, we should take that money and we should roll it over and put it into this fixed index annuity. So again, tremendous opportunity to offer some wonderful solutions to your clients. Okay. Again, whenever we do these distributions, you can take that money lump sum. You could take it as installments, and then and you can also possibly do an annuity. And so again, we're talking about annuities again, and this is where that annuity business opportunity really arises. But just so you know, whenever somebody takes money, like literally takes a cash distribution from their 401k plan, they've got 60 days to take that money and put it into these other plans. So I would say to put that money in an IRA, you know what, I'm going to switch this right now and fix this and say / annuity. How's that? Okay. So I just fixed that right now. There we go. So yeah, if you have a 401k, you can put that money in an IRA or an IRA annuity or some other qualified plan and roll over. They got 60 days to do it without having to be penalized or pay any income tax on that money. I'm going to skip that right there. Again, the different types of 401k plans are what they call a safe harbor 401k plan or a simple 401k plan, and or you can just do a regular 401k plan. So there is just a basic 401k, and then there's also a safe harbor and a simple 401k plan. Basically, a safe harbor, you know, what you do when you have a safe harbor 401k plan is for people who, where the employer who is making a lot of money wants to put money into it, but a lot of the people they're on the lower income type, you know, annual salary, they can't afford to put money in a 401k plan. So it's what they call a top heavy plan, and it starts to discriminate the low income paid employees. So what the employer can do is just say, I'm going to give 3% benefit to every employee. It doesn't matter whether they put money or not. And so they call that a safe harbor plan. So we can go with safe harbors as well. And I'd say a lot of my plans offer these. Simple plans have a little more restrictions and a little less money you can put aside, but that's another option too for small businesses. So I don't want to get into all this, but how you set it up. But if you know someone that you spoke to that needs a 401k or would like to upgrade their 401k plan, give me a call so that we can talk about it more in detail. We'll send you some documents and we'll send it in. And by the way, most of these 401k plans can be done just using a webinar. We just closed one last week with Catherine Simnowski, and we literally we did it using a webinar. Like we did the documents by a webinar. They were all DocuSigns. So we really didn't even have to go to the business. So pretty cool, you know, the things that you can do with this quarantine and leveraging, you know, our technology and all the digital platforms and communicating like we are right now, right? So, so anyway, that's what that is. Some of the benefits for the employer is it allows them to have tax-deductible contributions, cost-efficient means of helping participants save for retirement, permits flexible employer contributions. They can choose to put money in there for their employees or not to. It's very flexible. A way for employees to share the cost of retirement savings. So a lot of benefits to the employer, retention, recruiting. You know, like if you go and find, if people are actively looking for jobs, people can actually say, hey, guess what? We have a 401k plan, and that for a lot of people that want to find a job or, you know, plant their flag there could be one of those opportunities that you've got a retirement plan. Improve employee morale, reward service, builds company loyalty, all these different things. So there's tremendous benefits for the employer, and this big thing here, it shifts the investment risk to the employees. So this is a huge one, and this is why more and more people have gone from the traditional pension plans to these DC 401k plans. The benefit for the employees, it reduces their current taxable income, provides tax-deferred growth, which is what I've been talking about, provides a vehicle for employer contributions, helps create and safeguard retirement income, provides a flexible retirement savings vehicle, so they can actually contribute into a 401k or not put money in a 401k. They can skip payments. I mean, it's very, very flexible. And so a lot of wonderful benefits for both the employer and for the employee. Now let's talk about compensation to you, because obviously, you know, you're not doing all this stuff for free. You want to get compensation. And so one of the things that I want to talk to you guys about is the takeover plan. So earlier I was talking to you about 401k plans at freearisa.com. When you go to freearisa.com, you'll see, like, you can filter it. And as I said to you, you can look for accounts that have $5 million and up. Now, the way you get compensated on this is if I do a takeover plan and they have existing money in their 401k plan at $5 million, as an example, you're going to get paid by, let's say, Nationwide. Like this is, let's say I use Nationwide's platform and I also use Transamerica. Those are my two go-tos. But it's $5 million and you get paid 1%. So that's 1% of $5 million is $50,000. That's what your compensation is. Excuse me. So that's pretty good, right? I mean, you do like 5 of these a year. Excuse me, you're making $250,000, right? Then there's residual income on this as well every single year. To be extremely competitive on that $5 million, you get about 50 basis points every single year. Now, this 50 basis points is what you get on a yearly basis. So that means that starting in year 2, you're going to get now $25,000 a year. And that's if they put no more money into the account. And when I say they, that's both the employer and the employee put no more money in, and there's no growth. So you'll still get 50 basis points, which is 25,000. I haven't really ever heard of a 401k plan not growing, right, on a yearly basis, because you're going to have employees still contributing, employers are contributing, plus this $5 million is going to get some sort of a return on their market, or the market will give them some sort of a return, hopefully. And not guaranteed, but, you know, I mean, there might be a return there. And as this money starts to grow, it goes from 5 million to 6 to 7 to 8 to 9 to 10. Every year you get a 0.5% residual, which is 25,000, right? I mean, if you had 10 accounts like this, you're making $250,000, and it starts to increase, you know, exponentially over time. So, guys, what an awesome business where you're building residual income. And the best part about this is that this also has a multiple, right? Once you get a book of business like this, you can actually sell your business after a few years to an investor or to somebody like me who wants to come and buy your book of business from you, right? Or why would you want to sell it? You want to just keep it forever and get the residual income. So again, I'd be happy to discuss this with you even more, or talk to the person that invited you on this webinar today and say, hey, I love this idea. I think this is great. I think this will help a lot of people with their 401k plans, and it's a way for me to make some money as well. So consult with them, and I'd love to catch up with you guys this week and talk about this more in detail. I will send out another webinar link and let you guys know. We have all your emails, obviously, and so since we sent you guys the link to sign in today. So we'll send you another one, and that way we can actually go into freearisa.com and learn more about it. And I may even want to get somebody from Free Arisa to join us on that webinar to help you navigate through the actual site, understand the benefits of freearisa.com. So again, tremendous opportunity for you guys. You know, you're making 75 grand. You have 2 of these clients. You can make 100 grand up front and then $50,000 a year. And all you got to do is keep those 401k plans in place, you know, and really service those accounts. We have a guy out of Texas that actually landed a huge airline for a while, and he was probably getting, I don't know, somewhere between $500,000 or $700,000 a year just in residual income on a yearly basis, you know. And so, you know, it's nice. Let's see. So I have got a question here. I'm going to answer just a few questions here because I wanted to spend just an hour with you guys today. Somebody said, do you help people in Washington? Answer is absolutely. So I'm just going to say yes, 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 right? So there you go. Another question, is that only in California, any other states? Nope, it's in all states. We can help people in all states, so we'd be happy to do that. Let's see. I don't see any other questions. I think, yes, loud and clear. What advantages is not having health insurance? Oh, so this is, okay, so let me go back to, auto insurance here fast, because someone says, So Ramona asked, what if your passenger does not have health insurance? So if they don't have health insurance, number one, I would say, don't get them in your car with you. That's number one. Yeah, and if you're going to drive people around in your vehicle that don't have health insurance, then you probably want to keep uninsured motorists, right, Ramona? So that, so if they're not having health insurance, then they're going to need uninsured motorists, right? So again, uninsured motorists or underinsured motorists would really be there for someone who has health insurance already. If you don't have health insurance, then you probably want to have uninsured motorists. John, I thought uninsured covers me when someone who with no insurance hits me in my car. Is that not true? Yeah, but it's only going to cover you for your comp, and your collision will actually cover you for your car. But the uninsured motorist is for your health insurance. Okay, that came from Shy. I'd be interested in the webinar for free. Oh, great. So some people say, oh, I'm interested in your free ERISA. What is best approach to get in the door? So Lucy asked, what is the best approach to businesses to get in the door? So the best approach to get into a door is call the person that that one works for you, works at a company, right? Like somebody that works inside, like an employee. So there's so many different ways to get into a business. So number one is everyone that a friend or some coworker or whatever, everybody has somebody that has a job and they're participating in a 401k plan. And then you ask them, say, hey, do you have a 401k plan at your company? And if they say yes, they say, who do you have it with? And as soon as you find out who you have it with, give us a call or give your what we call your SMDs, those are your managers. Ask them, say, hey, I've got a friend who's got a 401k with Fidelity, with American Funds, or some of these other carriers. And once we find out who it is, we know what the issues are, right? We already know where there's some holes in their 401k plan. And to be quite honest with you, I think that most companies have some huge holes. Although I think Nationwide and Transamerica have the best 401k platforms in the country, and there's a lot of reasons for that I can't get into, but you can talk to them to get in the door, right, your employees. One of the best contacts is if you know somebody in human resources, or if you know the owner of the business itself, and if you don't know any of those kinds of people, right, that work inside at the level of human resource or a CFO or the owner, then go to freeerisa.com and you'll see all the people there, and you'll see why they're all the issues with their 401k plan at freeerisa.com. Okay, so I think I answered all those questions. How could life only license okay? So somebody said, how could life only license can they do 401k plans? Because a lot of these 401k plans, this came from Ya Meng, and the answer to that is because they use it as an annuity product, and and you're selling basically an annuity, and inside the annuity are these products and services. So it's kind of like a life license. Like an IUL, and I'm assuming, Ya Meng, that you know what an IUL is, that an IUL is tied to the S&P 500, and the S&P 500 really is the stock market in reality, right? It has to do with the 500 largest companies, but the person with a life license can actually sell an IUL, not without a securities license. Can you confirm this does not require securities or license? Yes. So again, going to that life license, that is true. What are the providers besides Nationwide and Transamerica? There's a lot of other companies like Fidelity has a 401k, Vanguard has a 401k, American Funds has a 401k. The problem with these mutual fund type 401k plans is the fact that most of these 401k plans only offer, or these mutual fund companies only offer their own funds. So Fidelity only offers their own funds, right? American Funds would only offer their own funds. Franklin offers their own funds. So there's not a lot of other fund families in there. Whereas if you go go to Transamerica and or Nationwide, both of those companies offer almost 1,500 different mutual fund families, and they're all what we call institutional type priced mutual funds, which means the fees are extremely low. So hopefully that helped you out, Iris. What kind of license is required? As I said, life license for a business owner looking to reduce their tax liability with setting up a 401k help. Yes, so this is from Yon, Y-O-A-N. She said, for a business owner looking to reduce their tax liability with setting up a 401k plan, help more of an executive bonus plan. Both are very good options. Both an executive bonus plan and a 401k are both wonderful options. What happens to your 401k when you switch employers? That's a great question. The money stays there, or you can just transfer it to a new company, which is why I was suggesting putting that money into a 401k plan and do it, an annuity, excuse me, and rolling it over. This is to clarify, if you want to go forward with a hardship withdrawal, specifically tuition, is there a 25? No. So right now, this comes from Alexis Graham. It says, if you want to go forward with a hardship withdrawal, tuition, is there still a 10 to 25% penalty tax? And the answer is there are no penalties for this right now under the CARES Act, okay? Is it allowed to approach your, John, I'm on, it seems like that we need to have a login. Yes, Shai, you need to log in and subscribe. How many employees must they have? Okay, how many employees? One, that's it, Ramona. That's all you need is just one employee. Okay, so they have what they call solo 401k plans, and so if you're just a one-man, one-woman show, you can have your own solo 401k plan. All right? So guys, my time is up. I mean, I went really fast. Again, we're actually going to take this webinar. We'll have it available up on YouTube. Give us a couple days. all our webinars that we've done over the last 2 weeks are being put on YouTube on my channel, so you can always go back and take a look at those. I know I went extremely fast today because I wanted to keep it to an hour, but I hope you guys got a lot of value out of it. Also, I just want you guys to know that on Monday, I know a lot of people have been texting me and emailing and saying, hey, you know, a couple of weeks ago you talked about the CARES Act and the SBA and how there was government grants and all this kind of stuff. And a lot of you said, oh, the money's already gone. It's exhausted. There's no more money, John. You know, I should have done it faster. You know, I'm screwed. I wish I would have done it and not procrastinated. Well, there's some good news, which is the government just released some more money into that particular program, and it will be up and running on Monday. This coming Monday, you're going to be able to go back online and reapply again for this for the SBA programs, okay? So I know a lot of you, which I love getting those messages, and if you do apply for one of these loans and you get approved and you get the money, a bunch of you have texted me and said, John, I can't believe it, I got approved, I got my grant, I got $10,000, right? I got a few $1,000s, I got, you know, $100,000. So congratulations, use that money wisely to pay for your bills and your expenses, office lease, you know, employees or whatever it is. But if you didn't get that money, or, you know, you got an email saying that there was no more money and the funds have all been exhausted, come Monday, they're going to re-offer that program, and there's more money put into that stream. So the main thing here, again, is not to procrastinate, folks, right? It's for you to make sure that you get in there and take advantage of these programs, because, again, like a lot of this money, up to $10,000 for those grants, may not even have to be paid back. They'll be forgiven for you. So I hope you guys jump on it. I hope these are all tools that are going to help you guys out. I hope that you enjoyed this program right here. You know, my wife and we are thinking about you guys. I swear, we're thinking about you guys daily. You know, some people said, texted an email and said, John, take care of your health. We need you healthy, and I appreciate that because they're worried that I'm working like 20-hour days. And the reason we're doing this because we really are so genuinely concerned for your well-being, your financial well-being. I hope that you guys are making money. And again, if you need anybody to talk to, please reach out. We're here and we're available to just talk for anything. It doesn't have to be business. If you just want to have a conversation and talk about what's on your mind, we'd be happy to do that, okay? We love you. Have a wonderful weekend. God bless every single one. Keep yourself quarantined. Don't let all this kind of, you know, this the flattening the curve thing kind of get you to feel like you're ready to start going out there and getting yourself exposed, okay? Still be very cautious about all this kind of stuff. Join us next Tuesday night. We got Tuesday Talks. We've got a very special guest, a really amazing special guest who's going to talk to you about branding and social media and all that kind of stuff, how to create a YouTube channel and all that kind of stuff. So this guy's a tremendous guy. His name is Omar later, and he'll be on next week on Tuesday night at 7:30. God bless every one of you. We'll see you next Tuesday at 7:30. Take care.